Look at me. I want you to listen to me right now, because what I am about to tell you could save you thousands, if not tens of thousands of dollars, in your retirement years. There is a massive, dangerous myth out there, and it is tripping up millions of hardworking Americans just like you. The myth is that when you retire, your taxes vanish. You think, Susie, I'm not working anymore. My income goes down, so my tax bill goes to zero, right? Wrong. It is a lie, and if you buy into it, you are putting your financial freedom at serious risk. The reality is that Uncle Sam does not retire. He is waiting for you, and he is hungry. When you stop punching the clock, your relationship with the Internal Revenue Service does not end, it just gets a whole lot more complicated. And if you don't understand how the money you pull out of your accounts is actually taxed, you are going to end up broke, frustrated, and wondering where your life savings went. I don't want that for you. You have worked too hard, for too many years, to let taxes steal your peace of mind. So today, we are going to do something raw. We are going to do something real. We are going to run through a real-life, down-and-dirty mathematical calculation. No textbook fluff, no confusing jargon. Just the pure, honest truth about what you will actually pay. Let's look at the problem. When you are working, your tax situation is simple. You get a W-2, taxes are taken out before you even see the money, and you move on with your life. But when you retire, you become the manager of your own payroll. You are pulling money from different buckets. You have Social Security. You have your traditional 401k or traditional IRA. You might have a Roth IRA. You might have a regular brokerage account. Every single one of these buckets is treated differently by the IRS. And here is the fear that keeps people up at night: what if I withdraw too much and push myself into a higher tax bracket? What if my Social Security gets taxed? What if my Medicare premiums skyrocket because of my income? Those are valid fears. Because if you pull $50,000 out of a traditional 401k, the IRS looks at that exactly the same as if you earned $50,000 working at a retail store. It is ordinary income. So let's break down a real scenario. I want you to imagine a married couple, both age 66. Let's call them John and Mary. They have done a good job saving, and they want to live on $100,000 a year in retirement. That is their goal. They want $100,000 of purchasing power to pay for their housing, their healthcare, their food, and maybe a little travel. How are they generating that $100,000? Let's say they get $40,000 a year combined from Social Security. The other $60,000 is coming right out of their traditional 401k accounts, money they saved over decades, which grew tax-deferred. Now, do not panic. This does not mean they pay an 85% tax rate. It means 85% of their $40,000 benefit, which is $34,000, is considered taxable income. The other $6,000 is completely tax-free. So, let's look at their total gross taxable income. We take the $60,000 from the 401k and add the $34,000 of taxable Social Security. Their total gross income for the tax return is $94,000. So, we multiply $21,700 by 12%, which gives us $2,604. To find their total federal income tax bill, we just add those two numbers together. $2,480 from the first bucket plus $2,604 from the second bucket equals a grand total of $5,084. Think about this. John and Mary brought in $100,000 of total cash to live on, and their federal income tax bill is only $5,084. That is an effective tax rate of just about 5%. Are you breathing a sigh of relief? You should be. Because when you see the actual math, the monster under the bed disappears. But, and this is a massive but, this only worked out beautifully for John and Mary because their income was structured correctly. What if John and Mary didn't have $40,000 in Social Security? What if all $100,000 came straight out of a traditional 401k because they claimed Social Security early and blew through it, or decided to delay it? If all $100,000 came out of that traditional 401k, their gross taxable income would be the full $100,000. We subtract their $47,500 standard deduction, leaving a taxable income of $52,500. The first $24,800 is still taxed at 10%, which is $2,480. The remaining $27,700 falls into the 12% bracket, which is $3,324. Their total tax bill would be $5,804. Still manageable, but higher. Now, let's take it a step further. What if they needed $150,000 because of a medical emergency, or because they wanted to pay off their mortgage? If they pull an extra $50,000 out of that traditional 401k, every single dollar of that extra money is going to be taxed at 12%, and as it crosses the $100,800 threshold, it jumps into the 22% tax bracket. Suddenly, they are triggering a tax bomb. Worse yet, as their income rises, their provisional income rises, making more of their Social Security taxable and potentially pushing them into a zone where their Medicare Part B and Part D premiums increase. This is known as the IRMA, the Income-Related Monthly Adjustment Amount tax. It is a hidden penalty that catches retirees completely off guard. So, what is the actionable takeaway here? What do you need to do right now, whether you are retired or about to retire? First, you must understand your buckets. You cannot wait until April 15th of the year after you retire to figure this out. You need a strategy today. You must become the master of your financial destiny. Do not let fear paralyze you, and do not let ignorance broke you. Taxes in retirement are not an insurmountable obstacle, but they require a plan. Look at your accounts this week. Calculate what your fixed expenses are going to be. Map out which bucket you are going to pull from first. Keep your taxable income as low as possible by balancing your withdrawals between taxable traditional accounts, tax-free Roth accounts, and your Social Security benefits. If you do this, you will protect your nest egg, you will keep Uncle Sam's hands out of your pockets as much as legally possible, and you will secure the safe, happy, and free retirement that you truly deserve. Stay safe and stay strong.